Good afternoon, everybody, and welcome back to the Schwab YouTube coaching channel for our next topic, Advanced Charting Techniques. I'm your host, Kevin Horner. Pleased to be with you all today. Thanks for joining me. I am joined today in the chat by James Boyd, fellow Schwab coach. He and I were on a little earlier this morning hosting the Trader Talk session. You can absolutely post your questions in chat for us today. JB will answer ones I'm unable to get to, and chances are I will be able to get to those specific questions. So don't hesitate, everybody. Please utilize that to give me your specifics. I'm happy to try and address them live and in the moment. And we'll try to learn some things today. Now, interestingly, this is my first opportunity to teach this class, and I thought we would bring in some concepts that maybe don't get addressed all that frequently. One of the things that I thought we would do today is look at the use of moving averages for intraday price charts. So what we're going to do is understand relationship in daily charts and how we could migrate some of our expectations on daily charts, or maybe our daily chart approach, to creating a finer understanding of entry and exit opportunities on your intra-period charts. Of course, everything we're going to talk about is merely a discussion around ways that some traders go about this stuff. None of it is obviously an encouragement for your use, or certainly a guarantee to work. But if you're a trader who is looking to find some more consistency, perhaps over your shorter term windows, this could be something to incorporate. So we're going to do that with some exponential moving averages. And we're also going to look at the use of the Fibonacci retracement tool today as well. So with that, we'll move into disclosures briefly so that we can get into the good portion of our discussion. So please remember that our conversations are exclusively for your information and your education. We do not make recommendations nor endorsements for a particular approach or strategy here in the market. Please keep that in mind. We will be covering technical analysis. Technical analysis is simply complementary in nature to our fundamental approach to the market. Of course, what an approach that makes sense is to balance some level of fundamental research, balance sheet, understanding of a company's health, etc., against price action. These two can work together in concert rather than necessarily setting you up for use of one versus the other. Think of them as complementary in nature. Okay, so with that, as I mentioned on the agenda, we are going to implement or look to implement some concepts as it relates to technical patterns. We're going to discuss the pros and cons of using a couple of these concepts, right? Exponential moving averages versus simple moving averages, and the use of the Fibonacci tools that are at our fingertips here, really just the Fibonacci retracement today. And we're going to talk about that as it relates to existing price action and see if we can't find some consistency in the patterns in the charts that'll help us out a little bit. So with that, let's get to it. I'm going to bring up Thinkorswim here, desktop application. I was playing with my details beforehand, so let me just move back to a daily chart of the S&P 500. Now, traditionally, if you're a familiar viewer here, you see us on Trader Talk, for example, you'll know that we rely frequently or utilize frequently these fairly standard moving averages. On my chart, I've got three of them. We're looking at the orange, a 20-day simple moving average, the purple, a 50-day simple moving average, and the blue, the lengthiest of our moving averages, the 200-day simple moving average. Now, I have titled these simple, right? What does that mean? So the simple moving average, of course, is taking only the closing value of the last 199 closes and incorporating today's last trade. And it's making an adjustment to that 200-day moving average. So it's taking all 199 plus today's last trade, adding them up, dividing by 200. That's how we get the current 200-day moving average. Now, if you'll notice, we are, obviously we're moving intraday here. We're up a little, we're down a little, we're down about 50 points here. The 20-day moving average is going to do the exact same thing. The last 19 closes plus today's last trade. Now, the reason I'm saying it like that, inclusive of today's last trade, everybody, is that remember, you will witness your 20-day simple moving average moving a little bit throughout the day, or the faster your moving average is, say not a 20, but maybe a 10-day, maybe even a 5-day moving average, the faster that moving average is, or the shorter the window of time it's measuring, well, then the more reactionary that moving average's line is, the dynamic nature of the line. So that's why some days you might start with the 20-day at a flat amount, and later in the day, because we had a huge day one way or the other, right, up or down, big, well, then that'll have an impact on your shorter term moving averages. It'll impact all your moving averages, but just keep this in mind. So as it relates to daily charts, I think the majority of traders probably rely on the simple moving average. The opportunity is certainly there for traders to incorporate the exponential moving average as well. The difference between the two is that the exponential moving average places heavier weighting on the most recent portions in the window of time being measured. So instead of the simple moving average, where we just add it all together and divide it by the number of days included in the moving average, the exponential adds more weight to what is happening immediately, what happened in the most recent window. And therefore, you might get more speedy signals, right? When I say signals like, hey, we moved through a moving average to the upside. If we moved through the exponential moving average, but not the simple moving average, for example, some traders would say that that is a false breakout, perhaps, right? They want to see some semblance of confirmation. So ultimately, traders need to decide, is it the simple moving average that makes the most sense for you? Is it the exponential that makes the most sense? And could it possibly be that simple moving averages may make more sense as it relates to your longer term periods, and maybe exponentials relate to timeframes of a shorter window? So let's look at taking our understanding of how the daily chart might appear, and let's move into an intraday chart and discuss some moving averages that traders might incorporate. So I'm going to open up my rail here, and we're going to hide this watch list and open my scratch pad. And what I did was provide you with some calculations here. So this might be a little difficult to see, but I'm sure we could zoom in briefly here just to highlight what I have offered. And it's the windows of time necessary to understand how to do these mathematical shifts. So as we move into the 5-minute chart, for example, I have different moving averages in here. These are not my standard 20, 50, and 200-day moving average. These are adjusted, and I can point to the top, and you'll see my details along the way, but it'd be easier if I just highlight it with my pop-up box from my studies here. So what I've added in, yes, I've got my pivot points added, but I've also incorporated 3 different windows of time. So what have I done here? Let's go back down over to my notes over here, the 5-minute chart. So all I've done is some math. We know that there are 78 5-minute candles every day of the week, right? On every normal session, I should say. So we have a 6.5-hour trading day. And if we take that 6.5 hours multiplied by the 12 5-minute blocks we get per hour, we end up with 78. Okay, now why is that important? Well, if I wanted to monitor the 5-day moving average for a security that was trending very quickly and moving very strongly, well, I could apply that to my 5-minute chart with an exponential moving average equal to that of 390 periods. Okay, remember, every moving average, whether simple or exponential, is going to utilize periods. And the period, the number of detailed moving periods we're talking about, is tied directly to the individual time frame of our candles. So that's why I've got it built this way on my 5-minute chart. So here on my 5-minute bars, the 390 period exponential moving average is akin to a 5-day simple moving average. Akin, not identical, but it's akin to it, right? Now, what is the 10-day? Double it, 780 periods. There I go, 780 right here. And number 3, the 20-day, 1,560 periods. That would be over 20 days at a rate of 78 per day. That is 20-day exponential moving average. I hope that makes sense, okay? So let's take a look at how the S&P is evaluating this. Now, my 5-minute bars might be too tight. I've got it 5 minutes and 5 days, actually 2 days at that moment. I can go back and make this a little longer. So let's stick to about 20 days. And let's just see, I mean, can we see periods within the very short run here where we could have chosen to stay long the S&P 500 and decided, okay, maybe to take some off? Some traders, if you're short term, you may have said, yeah, this move here where we broke down and then not just broke down, but could not hold this mid-range. So this, remember what this is. This basically broke the equivalent of the 5-day moving average, then came to the zone of the 10-day, bounced, but broke again, right? And that's what this move here is. So we bounced and broke down once more. And where did we settle? On our purple line, our longest line, that being the 1560 exponential moving average, equal to essentially here the 20-day simple moving average. So if you are like a lot of us, you're looking at the daily chart and saying, yeah, that 20-day moving average sure is important, and I want to utilize that knowledge in my intra-period chart. Sure, you could just take the value and say, all right, the intraday, the 20-day SMA today is at 58.12. I'm going to go snap a line. I'll put it in there on my intraday chart. But then you're getting a static line. You're not getting the dynamic nature of price action to account for what's happening today. That's why a trader might incorporate these on an exponential basis. Again, yes, you can use it. Good question, AP. Can we do this? The DMA, absolutely. Remember, DMA is nothing more than daily moving average. So, if we're talking the daily chart, 20-day moving average is fine. And if we're in the intra-period chart and your preference is to not use the exponential moving average, but use the simple, by all means, that can work. And again, my encouragement is not to take what I'm giving at face value and just only work with this. These are examples. And I'm going to give you another one here in a moment that'll expand on that a little bit and just give you hopefully the math to do. That's why I've got this in my scratch pad, so that you can all look at the basics, do the quick math, and say, all right, well, if I'm doing it on this time frame, utilizing candles that are equal to 1 hour block or a 4-hour block, this can give you some opportunity to make those shifts, to make those calculations, and to build the exponential or simple moving averages that are ideal for the way that you want to trade. Really, that's what we're talking about. Remember, process, not specific. So take the process and work with it, get it built to your specifics. I think that's what we're really wanting to highlight here. So once I've done this, okay, so here's my daily chart. You all know how I do this. I save my studies, save study set. I've already got it done. So my 20, 50, 200-day moving average with my RSI is part of that study set. When I move into my 5-minute bars, well, now I want to make sure that I've done the same here. So save study set. I've already got it titled 5-minute EMAs. This way, I know when I'm ready to step in and customize my 5-minute chart, I'm going to apply my 5-minute EMAs. Okay, so make sure you save it as such. This case, I'm just telling it, yes, go ahead and replace it, overwrite it. So all of my specifics relative to color of line, weighting of the line, style of the line, all of that remains. Okay, so now let's move in to an hour-long chart and see, can we learn something else? Well, Kev, you've got different moving averages on here. I've got 2 of them, a 52 period. I'll highlight this once more. A 52 period and a 137 period. Well, those sound pretty darn specific. So let's figure out what's going on there. So a 52 period is at 1 hour. We know that we've got 6.5 hours a day, right? So let's just use the, where's my calculator here? All right, so if I have 52 periods and I divide that by 6.5 as my reflection of how many hours there are in a day. So let's see, divided by, oops, sorry, everybody. All right, 52 divided by 6.5 is 8. Okay, So that's the 8-day moving average, akin to the 8-day moving average. Okay, that's my 52, that's purple. And then the other is a 137. 137 divided by 6.5. Okay, that's 21. All right, so what am I looking at? The equivalent of an 8 and a 21-day simple moving average. The reason I'm doing this is I wanted to give you a different look at things. Again, I'm not suggesting that somebody needs to work with the 8 or the 21, but maybe that's important for some traders, right? I know a few in the universe of trading who do rely on 8 and 21-day moving averages. 21 days, very common, the number of trading days in your given month, right? Anywhere between 20 and 21, most commonly the number of days you'll have in a month. And a lot of the technical analysis detail that we've done and been taught, believe it or not, stems from the lunar cycle, as it turns out. This is also part of things, believe it or not. So there's always a way to go about things. Ultimately, I think the reminder is that your time frame for trading matters, and what we need to do is find a process that works with that time frame and gives us consistent, confident signals. Interestingly enough, when I'm looking at the 1-hour chart here covering how many days are we looking at? 30 days, the last 30 trading sessions, 6 weeks, we have noted that we took out the purple 8, the 52 period EMA here. We went to the upside, we settled, we went higher, we settled and pulled back. We hit this 52 and we bounced. So hit the 52 and we bounced. Hit the 52 and we bounced again. And now we broke the 52, got bounced into it for a lower high, okay? Now, that doesn't guarantee anything, but what I find notable of all of this price action in here is that we've allowed that speedy, fast moving average to get caught up, and maybe that becomes our new trend of support. It could be, doesn't have to be, right? And remember, none of what we talk about as it relates to technicals, these are not things that are going to work every time. They're not designed to. In fact, our process as investors and traders should be tied to really comfort on our end. And utilizing the technicals should aid us in putting ourselves in places of comfort. Quick example for that. If you've been a trader sticking with the move since we gapped up back here, then the instances along the way where you might have taken action would have been right in this window here with the breakdown through the pink line, right? The 52 EMA on the hourly bar, the approximate 8-day simple moving average. We broke down, and some traders might have said, you know what? This was a wonderful run. I got in here when we started to move higher. We made our new short-term high. I got in and I moved up about 9.5% from there. And I ended up taking some off the table when we broke this level. Maybe you made about 8% on the trade. That's a wonderful a wonderful entrance and exit, noting we didn't take the initial entry, we didn't get out at the peak, but we did take the meat of the trade in theory, right? So if we did it that way and the trader took some off on this violation, there likely has not been, to this point, another reason to take more off just yet, right? Now, if the trader says, yes, under the green line, under the equivalent of the 21-day simple moving average, I want to make sure that I am protecting my remaining profits, that trader might then choose to sell if we show price action below this intra-period level, right? Now, again, that is not advanced charting strategy. That is advanced trade management, if we're being honest, but that is such a big part of the process. So can we take our daily charts and learn from those in our 5-minute charts, in our hour-long charts, and utilize those to maybe be a little bit finer in our exit or entry points? I'd like to think we can, okay? But no different than working from our daily charts are we going to be basing decisions off of anything other than the levels and analysis, the playbook, if you will, that we have written for ourselves. Okay. Okay, let's see here. Yes, I would be happy to share this. In fact, I'm not only going to place this grid, I will share my grid with you all. This is my single stock with intraday because I've got a 1 hour chart, 5-minute chart, daily chart, and then a weekly. We should also talk about the weekly, by the way. I mean, I've built my weekly charts using weekly SMAs, simple moving averages on my weeklies. So some of the fun stuff with the weeklies is not everybody wants to carry everything the same. Again, know how you like to go about things. So on my weeklies, it's a 20-week, a 40-week, and a 100-week. There may be value there, there may not. You know what? If we hide some of these, let's hide that 100 just for a second and hide the 20 for a second. The most obvious one here would have been the consistency that you can see from the 40-week moving average, which is basically the same as a 200-day moving average, pretty close to it, right around 10 months, right? And notice here your opportunities for trading above the major move. Okay, we broke it, we tested it, moved higher. Here you go. Basically trough to peak there, 60% almost. And if you didn't do it clean, maybe you did it based on a retest, something like back here, and then you got out when we broke down here, that's still 37%. And then if you notice here, when we were below it, you waited to get back above it. Maybe you waited to break the downtrend line here, and you got long until we broke down here. That's still another 30%. So again, what I'm getting at is we don't have to be the first through the door on any one trade. You don't have to be the first to leave the party on any one trade either. My hope is that the conversation encourages you to do some of this level setting and analysis so that we can move forward and be making our decisions in the moment, on the fly, rather quickly, without haste, right? That's the key, without haste. That's why thinking about it all before it goes to pass or comes to pass is so important, because if you've thought about it, you're going to give yourself that little bit of Rolodex to refer back to. You're going to go flipping back through all your notes, believe it or not, and you're going to find, I said this is what I might do if I'd liked it. I'd said this is what I would do if it broke down. I encourage you to use notes functions to make those decisions. Not everybody wants to see it on the chart, but you can always incorporate that right here, with make sure close some SPX on a close below. And I'm just going to point out the 40 SMA. And then I've got that note in here. And I might also make it a little bit larger just so it stands out for me. Yeah, I'm just needing some reminders from time to time. These things can be really, really helpful, everybody. Ricebird, I tell you, man, I've been singing Glenn Campbell all morning thanks to your call out of that song. I am a lineman for the county. Now I'm going to be the next Ben Watson here, and maybe James Boyd if I'm not careful. So I'll nip that one in the bud. Okay, let me share this grid with you all. Hang on a sec. Let's go ahead. We're in the SPX, so I'm going to go up here to my grid. Share grid. Yes. Now I'll remind you all, grids and anything we share here, please know these are not guaranteed for their accuracy. And they are not a recommendation for use. But if you'd like to utilize that, there you go. I will place this in the show notes as well, everybody, if you're catching this class in the archive as opposed to live. So hopefully this will be helpful for you. So there you have a fairly basic look at extending out your exponential moving averages, thinking about taking what's going on in your daily chart into your shorter term windows and incorporating that into your playbook for how you're going to approach things when the market gives you those chances. Are you going to shorten up your positions as you break down on short term levels, or are you more concerned with what's happening on those longer term levels? It's up to you, everybody. Know your own playbook. Know how you want to go about it. Some of us are the run and shoot offense. Others run the option. It's a very big difference between those two football offenses, and yet they can both win games. They can both be profitable approaches as it relates to the market. Hopefully there's some benefit to you all there. Okay, now let's get to some of my favorite stuff here, everybody. We're going to talk about the use of the Fibonacci retracement tool, another tool at our disposal to understand expected market moves. Now, I say expected once more. I got to restate it. Nothing that we expect is absolutely going to occur. But the more time we spend drawing our lines and working to understand the potential for given moves, I think the more we are going to grow in confidence when the development occurs. That is to say, when the prices do what you might have expected them to do. So a Fibonacci is simply relying on some standard calculations. We're going to look at the tool here. I'm going to use it on the S&P 500 because it's so prevalent. Very easy way to look at this. We're going to draw a Fibonacci retracement from where we were on April 7, that's our low down here, to the peak we made here on May 19. Now, the reason we're drawing it there is that it appears as though, as of now, that high is the highest high that we've had in this rally. And this April 7 bottom, certainly the lowest low we've had. So let's draw this line. So I'm going to I'm not right clicking anything. I'm clicking on the trackball on my mouse and it's giving me this pop-up window. Now I'm going to go to my Fibonacci retracement tool right here, just the percentage. And we're then going to start by left clicking here at the bottom and I'll take it all the way to the top. I just left clicked once. I don't have to hold it. And then I go all the way to the top and I let go again. I left click once more and it snaps in place. Okay. Now, what is this telling us? Well, the short-term look at this says we have an uptrend in place from this 48.30 level to approximately 59.70. Now, what a lot of Fibonacci enthusiasts will tell you is that you can move 50% down, something that some traders and users of Fibonacci's would call the supposed golden rule. You can make you can make a move to the up or downside and give back 50% of that move and still see the current trend hold. And what does that mean? Well, the current trend is the uptrend, right? Okay, so we have this uptrend in place. What it states is even though we might break the 20 and 200-day moving averages here and my uptrend line and potentially the 50-day moving average right here, what if we found ourselves over the course of the next 2 to 4 weeks hanging out around this area, the 50% level? Well, if we did, some traders would say that's their opportunity for not just a bounce of potential support, but an area where a trader who is waiting to participate might feel more comfortable doing so. Okay? Because we can commonly see a move to the upside, a give back of about half of that move, and still regain the uptrend. Okay? Once we break below the 50%, sure, we could talk about the potential for the 61.8% to be support. That's option 2, basically. But in all honesty, amongst the majority of traders incorporating the use of Fibonacci tools like this, when it has given back more than 61.8% of any given move, then the expectation is more likely something like this, rather a retreat back to where we began. Okay? So where do we begin? Always from the point of where the selling, in this case on the bullish side, where did the selling stop? And in this case on the upside to this point, where has the buying stopped? Well, we know that. We've got both. What's unclear is what's coming from here, right? Do we hold our trend line? Do we hold the 20-day moving average? Do we break it with conviction? Do we take out the 200-day? All of these are potential areas for short-run support to be exhibited by traders in the S&P 500. But if you incorporate these as Fibonacci levels, often what is noted is they line up at key areas, everybody. It's not uncommon Look. So we know the 23% retracement is like right here. Right here. Why is that important? It was a gap zone. You can't tell me that's not important. This stuff lines up. And so when you incorporate things like Fibonacci's with your standard look at horizontal support, horizontal resistance, you can learn an awful lot about what could occur. Further, you can learn an awful lot about what a trader might want to do if we fell through that 23% level on a closing basis. Some traders would say, yeah, Kev, that's all well and good. I don't want to stick with it if we took out the 20-day because we've been above the 20-day all the way back till April 23rd. That would be my first concern, is so what somebody might tell me, and that would be fine too, okay? Do these mathematical calculations. What is the difference between the 5820 and the potential to bounce off of 5,700? It's 120 points. Do you want to stick with the S&P and all of your investment for the potential to get down 120 points to get a bounce? Or do you want to start thinking about lightening up your load along the way? Oh, we broke the 20 on a close. I'm going to sell 25%. Oh, we broke the 200 on the close. I'm going to sell another 25%. And then what happened at the 23% retracement at 5,700? Well, we got a bounce. Great. You got a bounce. All right. Is the bounce giving you a close above the high of the low day? If the answer is yes, some traders would then say, oh, everything I took off, I now have to put back on, right? Because now the expectation is a bounce at a key level of support, close above the high of the low day in the pullback. That could be the opportunity to rejoin the shorter term trend here. And again, none of this do I know what's going to come, but I want to be thoughtful about it, okay? And the cool thing as it relates to the use of Fibonacci's as I see it, is we can absolutely take these thoughts in the shorter term and utilize them for aid in the decision-making process in the shorter term. Leave these lines on here. Let's go into that 5-minute bar. Do any of these lines look intriguing for me as it relates to whether it be maybe my pivot point support zones and things like that? I got to say, they don't, at least initially here, right? But boy, this last low lining up almost perfectly with the intraday R3 or support 3, the S3 level down here at around 57.70, that might tell some traders something here, right? And maybe some traders are also pointing out, hey, Kevin, we've got this higher lows still. Yes, we are bouncing off of the S2 right now here, right? But we've broken two key areas. We had that first exponential 5-minute moving average broken, the second broken. Yeah, we're rallying back, but what happens commonly when you break through support? Support becomes resistance. Would anybody be surprised if our rally back loses steam up here at around 58.80? Yeah, you probably shouldn't be surprised if it did. It's a possibility. Doesn't mean it has to, but it could. It could certainly move right back through it. We don't know. But I do know that if I was a trader on the short side, basically disagreeing with this bounce we're getting, my tune might change if we got higher than 58.80, right? I might have to take some action to protect any risk I have on the table moving against me. Because, if I took a short down here at the worst opportunity, thinking this breakdown was going to occur, and instead it's rallied back, I got to know my line in the sand where I'm ready to move on, everyone. So, Fibonacci retracements, certainly an opportunity for you, daily, intra-period, etc. Now, let's look at this utilizing the SPX on a monthly or weekly chart. I'm going to lift everything in here again, clear all the draw tools. All right, so let's take a peek at the long range S&P 500. Traders all the time wondering, all right, Kevin, how did we maybe make any heads or tails of the breakdown we got? Remember back in COVID, 5 years ago, we had this extreme low from March, and then we rallied real aggressively. Great move. Yeah, we used the 20-week pardon me, the 40-week moving average pretty consistently on the weekly chart here. But I just got done talking about some of the basics as it related to Fibonacci moves, right? Fibonacci's very helpful in helping us understand, can the selling subside? Again, we don't need to be the first buyer on any pullback, right? You can be, I think it was Michelle who said, yeah, I don't need that. I could be late. I just want the meat of the sandwich. I don't need the whole trade. I'll miss the first 5 or 10%, take the next 70 or 80 and miss the top 5 or 10 as well. Nothing wrong with that. But we said 50% give back is common, right? So let's check something out here. What if we drew a Fibonacci from our low in COVID to our peak thereafter? Now, that's interesting. Great move, by the way. Let's just draw that line so I can talk about the actual return. That's always fun to see. Actual return, about 118%. Nothing wrong with that. But then we pulled back. And what did we do? We pulled back to, oh, look at that, everybody. That is the 50% retracement. I think we talked about the importance of the 50% retracement, didn't we? So 50% retracement, we got to bounce. Now, was it easy to see in the moment? No, of course not. We got to bounce into the trend line, into former support, now resistance at the 40-week simple moving average. There was one resistance. We can take it on down to the next level right there. And then we broke through it and popped higher, but we had to come back for a test of that same line, didn't we? So that's exactly what happened. Now, you're not going to say that that's going to go that way every time, but we shouldn't be surprised, right? Now, 50% retracement, excellent push higher. You want to do it again? You darn right we do. Right off the 50% low to our peak. Oh my goodness, what do I have? Another 50% pullback test of the next leg up. Now, that's where I will agree, Ricebird. Amazing how it lines up. Does that mean we have to go higher? Absolutely not. Absolutely not. But if you were the trader who was watching this live and had these lines drawn in, the week it made that candle, you might have started to say, maybe I ought to start paying a little bit more attention, right? And if it didn't bounce and carry us where it has now to 5,900, almost 6,000, if it didn't, well, then that trader sure should have been willing to move on any move below 4,800, right? Like if we're willing to buy on a 50% pullback and check in, well, then we got to be willing to move on when we know we're wrong. Well, we're going to know we're wrong by the move to a new short-term low. So under 4,800, whoever bought it down here at the 50% retracement probably needed to sell some if it happened. Now, of course, in this case, it has not as of yet done that. Okay. Again, that doesn't mean we have to go higher, but I'm trying to show nothing more than just some ways that a trader can look at these levels, look at the rallies, take those opportunities to their benefit, right? Okay, now that's your basic retracement usage for a move like this, a pullback. Can we pull back 50% and then get a bounce? Yes. When do we start being confident in the bounce? Once we've pulled back, tested the level, and then traded above the high of our low day, or in this case, the low week in our pullback. So in reality, we didn't close above the high here until this. So really it was back at 5,500 where we really closed above the high of the low week. Okay. So this would have been perhaps the signal week. And if you were long from here, you would have probably done just fine, at least to this point, especially if you decided to take your profits. That'd have been about an 8% rally thereafter. Again, know how much you want to get from these. Not every move is going to be ideal, and not every trade is going to be one you're going to want to take. Okay. Well, George, it's a valid point. In an uptrending market, buying the dip strategies will work. And truth is, If you are a buy and hold investor, then holding in the extended long term has proven to be a very successful way of doing this over time, to be quite honest. Doesn't mean it's going to continue to be that. There's always the opportunity for cycles to be impactful on us. And so we have to be disciplined nonetheless. But yeah, historically, that's proven to be true, George. Okay, the last thing I wanted to talk about was how we might look at a breakout move to start targeting upside opportunities. I'm going to use the SPX again. I'm sorry, guys. I know it's kind of boring, but the S&P, if you want to find, the most consistent moves, I think when you incorporate the large cap stocks like this, it seems like the S&P is among the more consistent. It's certainly the one that the majority of investors and traders eye. So from a usage of examples, it really can be helpful. So another way that some traders will look at Fibonacci's is to evaluate highs and lows. All right, so we had a high trade, we had a pullback, and now we're breaking out over here. So what we want to do is I'm just going to say we're sitting on this with a potential breakout, and traders are saying, all right, Kevin, if we're breaking to the upside, how much higher can we go? Well, some traders will utilize the Fibonacci retracement tool, will draw it from the peak, and then pull this back to right here. Okay, so here we've got the full sell-off. Now we have managed to push through, or are possibly pushing through 48. And then we can look at these extension opportunities to see where could the buying take a breather. Okay, so let's draw one line in here at the 161.8, and we'll do another at the 261.8 right there. So these are the levels. Wow, that's huge. So I'm just going to go forward weekly here, everybody. Notice as we get into it, how about that? That 161.8 became initially resistance, didn't it? Boy, did it. It once, twice, back-to-back weeks, we pulled back and found our 40 week. We moved off of it, went right back to that same level, got rejected again, had to make a higher low, and then we finally moved through it. And now we're, able to look at 5,600 as something else. As I continue through, notice 5,600 acted as that pause briefly on our bounce back even still, didn't it? So, again, these are not perfect calculations. They are very interesting relative to price action, I think. And again, drawing these lines, they're, the 161.8%, that extension ledge, or the 261.8, they're not going to be guaranteed to work. I can show you on CoreWeave, one that has been very hot of late. It would not have worked, or you would have maybe capped your profits if you'd have looked at this one. I was looking at this utilizing something like a 4-hour chart because the stock was very new. And you can see here how that purple 52 4-hour blocks, that's a little different. Okay, that's not using the same math. I got to point that out. But if you use your Fibonacci's here from the peak to the bottom, based on this breakout, you might have started taking profits at 83 and maybe even at 113. You would have left some dollars on the table if you started doing that. So I wanted to point this out because there will be instances where momentum destroys your trade plan. Okay, destroys it altogether. My hope is that we are comfortable and confident taking profits and much less worried about, did I take enough profits? Hey, I made a great trade, pat myself on the back, and move forward, right? If you're ever worried about, did I do the right thing by selling? A lot of traders think about just selling some, right? Because if you sell some and you keep some, if it goes higher, you were right to have kept some. And if it drops, you were right to have sold some, right? So it's all about mentality and all about your process, everybody. So we'll go ahead and wrap up there. I love talking about this stuff. Many of you are familiar with this. And of course, I don't get to go to the depths that we did here today in Fibonacci's or even the exponential moving averages as we discussed. But I'll tell you, I love this stuff. I love talking about it, and I love bringing it into the classes. So if you're looking to see where we incorporate really all of this stuff, normally it's going to be on Trader Talk. So Trader Talk Mondays, Wednesdays, Thursdays, and Fridays. Be on the lookout for that, everybody. We're on the calendar there. As always, more to come from us here on the YouTube coaching channel. So follow JB and me on X, Kevin Horner, CS, James Boyd, CS. Hit that thumbs up button down below for me as well. We're going to get this one reviewed and into the archive ASAP. And I'm also going to get the grid into the show notes for those of you catching this in the archive. So as always, thank you so much for joining. I hope you all had a great short market week, and I look forward to following up with you all again next week. So have a great weekend, everybody.